Yes, I can see myself. There we are. Fantastic. Morning, everyone. As Neil said, I head up the research team at Lomres. For those of you who don't know who Lomres are, we are an online sort of business-to-business site for agents. They subscribe to the site and they feed us information about their properties, and they can do deals within the site to share commission. Where this becomes interesting from a data point of view is that we have arguably the most up-to-date set of data on the prime central London housing market. So we're tracking both sales and lettings properties from the moment that they go on the market to the moment that they come off, whether that be through a sale or letter or withdrawal. So we can give you and our subscribers really up-to-date information on what's happening in the market. So I'm just going to talk you through today some few slides on the sales and lettings market in prime London. Just to give you an idea, there's lots of people use different classifications of prime London. Ours is a geographical one rather than a price bracket one, although obviously it takes in some of pretty much all of the most expensive postcodes in the UK. So our area is roughly zone 1 and 2 on the tube map, so kind of Hammersmith in the west to just over from the city in the east, Hampstead in the north, down to Clapham in the south. So that patch there is the one that we tend to talk about when we're talking about our sort of wider prime London area. So moving swiftly on, because I know that Neil's got a few things he wants to chat about the market with me afterwards. Firstly, this first slide looks at sales. Actually, Neil, can we look at the previous slide? Is that okay? That's the one. Brilliant. So this slide here looks at monthly sales across our prime London area compared with the same month in 2019. So annual changes for sales, which we measure the date of exchange. So sort of pretty much the point of no return for a sale. Under offer, so the date at which an offer is accepted on a property by a seller, and new instructions, so the date at which that property comes onto the market. As you can see, first couple of months of the year, we saw some pretty significant increases in sales and under offers and new instructions across central London. I mean, pre-COVID, we were pretty confident about the central London market. Buyers were seeing value and we saw activity increase. Obviously, lockdown put pay to that, and we saw the market pretty much shut down, which meant that under offer levels and new instructions dropped back sort of pretty simultaneously. So in April, for example, we saw an 80% reduction in the number of properties going under offer and around an 80% reduction in new instructions as well. So the market pretty much shut down. For exchanges, it wasn't quite so stark, the contrast, obviously, because there were properties within the system that were going through. So we didn't see this drop off as significantly, although, as you can see, we were almost 60% down in both April and May. Once restrictions were eased, in middle of May, we did start to see the market return relatively rapidly, actually, compared with the depths of the downturn. I think we were all fearing that 2020 was going to be a pretty disastrous year for the housing market, and actually it came back pretty quickly, and we started to see activity increase. Obviously, exchanges were delayed. We saw the time between under offer and exchange increase from an average of around 2 months pre-lockdown to just over 3. So properties were taking longer to move through the system, but under offer activity increased. So we saw around a 10% increase in July and 8% in August. Interestingly, the line which shoots up in August is new instructions. Normally, August is pretty sleepy for estate agents in prime central London on the sales side and across prime London, really, because children are home from school, people are on holiday, they're at their second homes. The thought of listing their property in prime London is not top of their list. They either would have listed it in the spring or they waited till the autumn. This year's slightly different, and I think that stamp duty incentives obviously help there too. but we saw a 97% increase in the number of new instructions. So lots of activity. And talking to agents, quite a few of those people who are bringing their properties to market are owner-occupiers who want another property in quite a few of them in London, obviously some outside of London. So hopefully it's a good sign in terms of what we're going to see in terms of market activity moving into the autumn. Can we move on, Neil, to the next slide? Thank you very much. So in terms of which markets are busier than others, we've just split our sort of exchange data for July and August this year compared with last, and compared it by price bracket. Interestingly, the market has recovered more quickly over 2 million, whereas under 2 million, it's been quite a bit quieter than last year. There's quite a few reasons for this. One of which is that over 2 million people, there's a lot of more cash purchase, so these people can move more quickly. So those sales may be going through. There's also a real kind of lifestyle aspect to people's moves at the moment. So these are people who are looking for long-term family homes or an investment in central London, and they're happy to commit. At the lower end of the market, which is where you tend to see more investor buyers, there's been less activity. Also, this may be the market where we're seeing more people selling up and leaving London. So rather than selling a smaller flat and buying a larger flat in London, they are buying a house outside of central London. So we've seen this sort of drop off at bottom end below 2 million. Sounds a bit ridiculous in a lot of contexts, but that tends to be where we see it. It's sort of 2 million plus and below 2 million. And 2 million has been under 2 million has been a lot quieter over the summer. We'll obviously be keeping an eye on this into the autumn, whether it is just to do with the mortgage versus cash, or whether it is sort of a longer term theme coming through. Can we move on, Neil, to the next one? In terms of the impact on prices, this is my last slide on sales. We have seen the average discount, so the sort of greeny blue line there, fall back slightly. So we were average discount off initial asking price of around 9% at the beginning of the year. This has dropped back, so we are at around 7.5% now in terms of the average discount off the initial asking price, so the price at which the property was first listed. In terms of what's happened with price changes, the momentum that built sort of early in the year, you can see coming through in price growth. I mean, we saw price growth of sort of 9 to 10% annually in February and March. I would say that early 2019 wasn't sort of a vintage period for the central London market, and part of this is due to the sort of the recovery that happened in the latter part of last year as well. But as I was saying earlier, a lot of that momentum was building earlier in the year. It did drop back, so we saw falls of just over 3% in May, albeit off quite small volumes, so things were a bit jumpy around that period. But it's recovered quite quickly since, and we've seen just shy of 3% increase in June, 4% in July, and just shy of 3% in August. So prices are up on last year. And I think, whilst the £15,000 saving on stamp duty is not going to be the deciding factor if you're buying a £5 million house, it does help in terms of, add a little bit more money to people's pockets when they're trying to negotiate. And also, I think, possibly more importantly, it kind of reassures buyers that the government are sort of putting their money behind the health of the housing market. And so so some of that growth I would expect has been down to that sort of the introduction of the stamp duty holiday in July. So obviously interesting to see potentially what whether that has the opposite impact after April next year. But for now, we're pretty confident about the market, certainly for the next couple of months. Should we move on to the next slide, Neil? Thanks. So moving on to lettings, quite a different picture actually for lettings, and the impact of the lockdown, COVID, social distancing, and work from home has been pretty significant on the prime lettings market. a market which is pretty much driven by people needing to be close to their office in central London or close to their university, or paying relatively significant amounts of money to rent somewhere in the centre of London. And I think we're seeing similar problems in other cities around the UK. As you can see, the green bars here, the new lets and under offer. Obviously for lettings, under offer and new lets happen a lot more quickly than maybe for sales. But we saw quite a significant drop off as the market locked down, as you'd expect. People couldn't move in. So we saw around a 70% drop off in April and in excess of a 60% drop off in May. What we did see was not an increase, but less of a drop off in the number of new instructions. So we started to see over lockdown levels of stock build across central London as more stock was reaching the market that was leaving the market. And as you can see, since the market opened up, whilst the situation has improved, we're seeing around sort of 25% fewer lets per month since June. So the market is undoubtedly quieter, but new instructions are higher or on par with where they were a year ago, which means we've got around 60% more properties on the market to let now than we had at the same point a year ago. So can we move on to the next slide, Neil? Thanks. Lettings more than sales is quicker to react to sort of imbalances between supply and demand, and this has been shown with what's happened to rents across the first sort of 8 months of the year. Earlier in the year, whilst activity was pretty subdued, there wasn't a huge amount of stock, so we saw rents rise pretty significantly. I mean, in February we saw an 8.1% increase in rents annually, which is for the rental market pretty significant. But equally, as stock continued to build, we saw rents drop off relatively quickly, and landlords becoming more keen to attract tenants. So the green bar here looks at the percentage of properties that had seen an asking price reduction before finding a tenant. As you can see, at the start of the year, we were just over 20%, I think 23% in January. By August, it was 49%, so almost half of properties that were let had an asking price reduction, which has obviously impacted on rents. And in July, we saw an 11% annual fall, and in August, a 6% annual fall. So I think sort of for lettings, it is going to be a challenge, and we're going to be closely looking at sort of the relationship with levels of supply, because I think that if that doesn't come down over the next couple of months, we're going to see some greater falls in rents.
Thank you, Marcus. And it turns out I had a slight microphone glitch at the beginning, so my introduction probably didn't come through. So thank you for
I heard you, so it's fine.
over there, and thanks for that fascinating look at the market. And so it seems that normally following a recession or a house price slowdown or a market close, you'd expect the central London market to be the market that kind of takes off and leads the recovery. That certainly has been the case in the last few downturns, and it's arguable whether we've actually had the downturn yet or not, but actually this time round it looks like the central London market is struggling more than most, and that actually comes off a few years of it having already struggled and kind of having fallen from its peak in what was it, 2014, 2016 kind of period. Yeah. I mean, is this an unsurprising development given what we're seeing across the country?
I think that it's what's been slightly different this time around, and it's very easy to compare it with previous situations where the economy has been in sort of difficult times, but obviously it's slightly different this time around. But I think what has been interesting is that the types of people, prime central London in particular, but most of prime London is a pretty discretionary market. So It's all people who who want to buy at that particular time, and they're choosing to buy in central London. A significant proportion of those, particularly as you move further up sort of the price bands, are from overseas, and those people just aren't really in the market at the moment, or if they are, they can't necessarily travel over and view those properties. So I think we're seeing we're not seeing the demand from those buyers, whether that be for their own occupation or for investment that we had done. And also I think that what seems to be happening is that a lot of people are buying for lifestyle reasons, and that may be just be that they've spent a significant amount of time in their property during lockdown, and they've decided that they either want a complete shift in lifestyle, or they want to add additional bedrooms or additional space. And I think that the difficulty is that for central London, which has a relatively high proportion of flats with no outside space, that those sort of properties aren't particularly sought after at the moment. So the appeal of a cottage an hour and a half from London for around the same price, if not a bit cheaper, is undoubtedly sort of slightly damaging the market at the moment. Albeit we're still seeing more activity in terms of under offers than we saw last year.
Yeah, ultimately, all those people who are moving out of London, a large proportion of them will be existing homeowners, and they'll be needing to sell into the existing market.
Yeah, yeah, I think that's going to be the challenge. I think for certain property types, I think that one of the we've seen that increase in sales at sort of 2 million plus, and a lot of people buying at that level. They will be buying something with outside space, probably close to a park or on a garden square. So actually it sort of almost ticks the kind of country and town box for them. But yeah, as you say, if you've got a sort of a flat with no outside space that you need to sell in order for you to buy that, then it might be a bit more of a challenge at the moment.
Yeah, so a real divergence in the type of properties and what's happening there, and clearly that also feeds through into the rental market. The rental market will be predominantly found in kind of flats, kind of smaller properties and things like that, and clearly that market is looking very weak at the moment. Have you seen much interest from investors in the market, or are the rent falls putting them off?
I think that there are always investors who are ready to buy at a certain level, and I think that the challenge has been not just, to be honest with you, not just since lockdown, but before that, in that a lot of people, particularly overseas investors, expect that they will get a significant discount for people selling in London. And I think that the difficulty is if they're coming in and they're wanting to buy at a certain discount, but people don't necessarily need to sell. Central London is a cash-rich market, and the cost to hold those properties is pretty insignificant. It's pretty much just the council tax. So I think that there are investors around, but I think a lot of them are disappointed in the fact that they can't secure the deals that maybe they think that they can. So I think that that's going to be the challenge. I think, and the issue with Central London is that the people who are investing in Central London have never really been doing so for yield. They've been doing it for capital growth, and it's all about where they see sort of their investment in London will be in sort of 10 years time. So it's they're looking for the best deal now. Whether they'll be able to get those deals is debatable, I think.
Yeah, it's a situation we see increasingly across the rest of the country, where larger numbers of homeowners without a mortgage, older people, there's not there's less of the financial pressure to sell, and that's especially so in the central London market. And I suppose one of the questions that everyone is grappling with is the scale of the bounce, and kind of the evidence so far is fairly fragile across the country. And it's much less so. There's much less evidence of a bounce in central London, but then a lot of attention is then turning towards the end of this year. And you mentioned in your presentation, kind of the March-April threshold for stamp duty. How do you see the future of the central London market evolving over the next, say, 6 months or so?
I think that my view is, and I'm quite fortunate in that we don't do any official forecasts, which at the moment is a real blessing, because it's difficult enough to forecast in sort of a more stable economic environment, and at the moment it's sort of challenging, verging on impossible, I think. But my view would be that actually, in terms of prices this year, because of the length of time from under offer to exchange, really we're talking about sales. We're talking about offers that are put in between January and October, and we're not actually that far away from October now. So I would think that this year we will end the year slightly up, possibly at the same level or slightly up, a couple of percent up from where we were at the end of last year. I think that the first quarter of next year is likely to be relatively busy, unless we start to see mass unemployment. I think that people will be, that stamp duty incentive is still there. It is slightly difficult because you worry that actually are people going to pay 15, 20, 25, 30,000 pounds more to make a 15,000 pound saving. But that saving is there, and obviously stamp duty is not mortgageable, and an increase in the price of the property is. So I think that we'll see that momentum go through into the first quarter. We've also got the increase in purchase taxation for overseas investors that comes in April. So potentially some of those might look to sort of to nip in beforehand and purchase. I think the challenge is going to be in the sort of the following 3 quarters of next year, and the impact of sort of the potential economic downturn on the market. Interestingly, I'm slightly more positive about prime than I am about the mainstream market, just because of the amount of cash and equity driven purchase. I mean, very few people who are buying in prime London are buying with high loan to value mortgages, and if they are doing so, it's because it's they're making more on their money being invested elsewhere, so they're taking out these significant mortgages. So I would imagine that banks would be a lot keener to lend to these sort of relatively low risk purchasers maybe than they would be first time buyers or people buying with higher loan to values. That said, there's got to be the buyers there in the first place to want the mortgages. So I think it's going to be a challenging time, but I think that we're going to start to see probably this time next year what that impact's going to be. I know that there was something that came out. It may have been the CBR thing that came out yesterday or early this week that talks about sort of potentially 15% fall in prices next year. I don't think it's necessarily going to be that bad. I think that what the downturn since 2014 has taught us about the central London market is that because holding costs are so low and there's so much equity, it's more likely that the market will just slow in terms of transactions, because people will just decide, I don't want to transact at that level, and they'll pull their property from the market. So, which obviously isn't great news either, but I think that will shield against any really significant price falls that we're potentially going to see.
Yeah, I do wonder whether the performance of the central London market in recent years is a guide to what might happen to the wider UK market in coming years. We might see transactions adjust more than prices as people sit tight and mortgage forbearance in the second-hand market. I mean, the other thing, obviously, and it's always difficult to know exactly what implications are, but Brexit is in the news again, and clearly the London market is highly dependent on overseas both buyers and also residents. Are you picking up any signs from what their attitudes are towards Brexit?
Well, I mean, I think that it has been and will continue to be a challenge for certain particular markets, like South Kensington, for example, which attracts a lot of mainland European financial sector buyers and tenants. Those people are less likely to be coming across to the UK in number. The people that are there aren't necessarily going to leave, and I think that a lot of people thought there would be this mass exodus, and I think the people who are there are not necessarily going to leave, but it's whether new people will come in. So those markets, I think, will be quite challenged. The flip side of it is I think that there may well be investors from other markets who could see potential in London because of Brexit, and that things that open up and possibly links with other countries. So whilst we will, I think, lose some sources of demand, particularly European buyers, which actually I think a lot of people talk about buyers from elsewhere in the world because they're the ones who often are the big spenders. But actually, there's a lot of European buyers in central London, spending £1-3 million each. But actually, if you add them all together, they're quite a significant force. But actually, whilst we may lose some of those, potentially we could attract buyers from other countries, like sort of Hong Kong at the moment, possibly Belarus. I don't know, but I think that it is a challenge for the market, but also potentially a source of demand. And at the moment, the global economy is in trouble, and London has been one of those markets traditionally where in times of difficulty those people have flocked, and I don't necessarily think that changes significantly because of Brexit. It'll put some people off, but no, I think that it could potentially benefit London. It's sort of too early to tell, really.
I suppose there'll be lots of people looking for a discount. The question is whether that discount will be there for them or not. Yeah,
and I mean, interestingly, we often talk about a discount off what as well. So if a property is 20% overpriced and you get a 15% discount, you're still overpaying. And I think that's been the real challenge. And I think that what has been very interesting is actually that the biggest savings that a lot of overseas buyers have made have been on currency fluctuations, not on changes in prices. So for central London, 2014 compared with now, if you're buying in dollars, you're buying at a sort of 40-45% discount to 2014. If you're buying in pounds, you're sort of 15 to 20% off. So actually, more importantly, sometimes in the sort of negotiation process is when you move that money across, rather than getting an extra £50,000 off the price of that property. So I think that it'll be as important to watch what happens to prices as to what happens to exchange rates over sort of the next sort of 6 months to a year.
Great. Well, thank you, Marcus. I think that's probably taken up enough of your time. So thank you for that. It's absolutely fascinating. And,
thanks, Neil. It's great to speak to you.
Thank you.